rejections, volatility, how to deal with failure. All those things are questions that I think anybody who has high goals in life has to be able to answer. I once watched a documentary about big wave surfers, and I always forget this line where they said what they really need to understand is how to survive a big wipeout. That's what they need to survive. It's not the surfing. It's not all the technicalities of surfing. It's how to survive the wipeout. And I think every big wave surfer can attest that. Every extreme skier, every hedge fund manager, every athlete, every artist. It is the moments of failure and rejection that define your success. It sounds almost counterintuitive, but that's really what it is. And the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. And I think I haven't spoken enough about this. There's been a time in Silicon Valley when failure was all the rage, and I kind of want to stay away from that. So the last thing I want to say here is, oh, you need to learn how to fail or something like that. Don't fail. You don't succeed. Be good at stuff. Make ends meet. Deliver on expectations. Like, don't fail. But nevertheless, life, it's just, nature is such that since we don't know all the outcomes, we have to understand how to error correct. And I think that the way I want to do this in this particular episode is I want to use a Popperian approach. Instead of talking about failure and telling people to learn how to fail and all that stuff, I want to talk about error correction, because this is what really is going on here. You know, a compound interest, either in money or in life, is a function of iteration. The more you iterate, the more you compound experience. Assuming you're whatever logical in your approach to its iteration, you will fix errors and get better. So compound interest is a function of iteration, but you need to be able to error correct. And the cost of error correction, first you know how to error correct, and second, you need to make sure your cost of error corrections are low. I want to talk about those two things and discuss the general concept of dealing with rejections and failure. This is Not Even Wrong podcast. It's June 17, 2022. This is Krim Jelko. I'm still in Europe, so it's morning here in Europe, and the markets are closed in the US. As of right now, we are down 51%. For the year, the market's down 23%. We're underperforming by 28%. Like I said yesterday in my episode, the futures were showing down, and the market was down quite a bit. We were down also yesterday. So we're actually now at the lowest of the year. It is pretty hardcore what's going on in the markets, because basically what the Fed is doing is it wants to create a slowdown and therefore deal with the supply chain issues that way. The Fed can't print oil. This is one of the sayings that obviously is true, but what it really means is that the supply chain issues that we're facing on the commodity side, on the chip side, on people don't want to work, they want to work remote, which basically is just another way for people to ask for higher wages or less productivity or both. So all of these things are now being crushed by the Fed, because what the Fed is doing, either intentionally or unintentionally, saying, look, I can't make people work more productively. I can't get more oil and nat gas to the market. I can't produce rare earth metals for electric cars. So what I'm going to do is I'm going to slow down demand for everything in the economy. So that way I open up supply chains. So let's, for example, hopefully, and this is what we usually get in times like this, is that we have a correction where everything gets slaughtered, sort of a cryogenic therapy where everything goes down to its lowest point of energy, if you want, and then we rebuild. So let's take an example, the way we think about our portfolio. Tesla is a company which is doing something that people want now and they will want in the future. But Tesla is also suffering from supply chain issues like everybody else. And if everything gets cryogenically slowed down by the Fed, and then we rebuild after let's say we have a recession, and then the Fed starts easing, and the demand comes down, and money supply goes up, and all these things come back to a state of more, I don't want to use the word normal, but just more palatable for investment and consumption. Then we will have more assets and more resources available to Tesla. We will have more electric cars. We will have better solutions for decarbonizing energy. and so on and so forth. This is why after big downturns, we usually see the sort of the winners of that particular area. So the Amazons or the Microsofts or the Apples or the you name it, who they come back much harder and they create a lot more wealth than one could have ever thought before. So this is the way we see it. So our goal now is, of course, to survive. We said that many times. Survival is the key. Surviving means being able to sustain our fund with the leverage. We are managing our leverage very carefully. And we're also, of course, managing our cost structure or even our own, personal cost structure, because that's just another form of leverage. So coming back now to the main episode here, or the main theme of the episode, which is, okay, how do we deal with rejections and failure? And I want to take two examples here. Let's start with rejections first. It's not quite the same thing, although maybe in the extreme it's the same thing, because a failure then leads to rejection of customers or rejection of the market, just telling you can't participate here. And that's just another word for failure. But let's keep it simple just to understand. So a rejection and failure. Let's say you're an athlete and you want to join a very elite team, and you try out, and the question is, are you going to get in or not? And what happens a lot, and you can attest that, any kind of athlete will attest that, you do get rejected a lot. Even the best, the best of the best, at some point in their lives have been rejected. And that's almost a natural function of your inability, or a person's inability, to exactly calibrate themselves. Okay, so this is not a bad thing. I would argue that even people like Lionel Messi, Ronaldo, LeBron James, even the top-notch athletes, at some point in their lives probably had to deal with rejections. And that is just because they might have been very talented even at young age, but then they reached higher. So maybe, I don't know, Lionel Messi, when he was 11, wanted to play for a 14-year-old team, a team of 14-year-olds, and he got rejected. So things along those lines, that's what I mean with rejection. Like, you're just not able to calibrate yourself 100% in terms of where you stand, and then you have to error correct. And this is the key, what I meant when I said I want to approach this topic in a Popperian way, which is, okay, listen, you're going to iterate. So the most important thing, I think neuroscience teaches us, anybody I talk to who has anything to say about mental strength, physical strength, success, any of those things, would tell you that iteration is important. I think we have said that many times also on the podcast here, that for companies, for disruptions, for all of these things, iteration is the key vector. So iteration is important, but when you iterate, you're going to make mistakes. So let's say you're an athlete, you're a youth athlete, you're playing in your age group, and you start iterating, you want to do something else. So what are you going to do? You're going to try to play a higher age group, for example, and you're going to maybe get a rejection. So what do you do with that rejection? Well, the error correction, of course, is, okay, you think about, well, okay, why was I rejected? And the reasons for rejections in athletics is often, like in many positions in life, actually, it's not even related to you often. It's related to things like, well, do I need you? So is there a spot for you in that particular team? To use another analogy, if you are a hedge fund manager trying to raise capital and you get rejected by an investor, well, maybe they just don't have capital to invest for you specifically. Maybe they allocate it to somebody else. So very often it's not you. And I would argue that if you are able to calibrate yourself within a certain error range, and there is a need for what you supply, then usually you will actually get the job. So the rejection is often not, this is the important thing here. The rejection is often not you. It is actually them not being ready to offer you the spot, either because maybe they're not good enough, or maybe they don't have the assets, or maybe you just came at the wrong time. So this is very important. And I think this now goes back to you, meaning you being the athlete who's trying to play in a different team, maybe higher age group or higher class or higher league or anything like that. Well, try to assess if there is a need on their side for you. That means that you need to understand who you are, what your strengths are, and what you can provide to them. And then think about also, if you have that information, is there a need? So that way you also reduce your cost of failure, which is, if you iterate 10 times and you get rejected 10 times, that is costly, not just in the sense that the iteration itself costs money. Let's say when you do tryouts for a team, you have to fly around here in the US, even in Europe sometimes, and that's money. But it's not just that money; it's also the cost of course, the mental cost, which is the rejections just take a toll on you. So you can reduce that by being a little bit more specific of where you go, who you ask. So I think, for example, let's take an extreme example. You're a mediocre player, a soccer player in a team that plays in a mediocre league, and you're doing an open tryout with an MLS Next team. Well, maybe you're not going to succeed because you're just not at that level. But if you are at almost at the cusp of being at that level, you've done everything that is necessary to succeed. You've delivered in actually extreme situations. Let's say you're a player that has played in your age group. You've played up in an age group. You've delivered wins. You've delivered, you've made the decisions. Let's say if you're a goalkeeper, you save penalties. If you're a striker, you scored. So you've delivered crucial moments for your team, which is already very high level. And now you're trying to go maybe a little bit more high level or a bit more prestigious. Those are the kinds of situations where you have the assets, you have the resources, and if there is a need on their side, then the chances of you succeeding are actually very high. The same analogy on the hedge fund side would be that if you're a hedge fund with a very high return, very good track record, and a good concept, for example, we hope to be able to say that here at Orange Capital Partners. The purpose of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practices. And our main criteria of investment is the natural Sharpe ratio, which I don't want to discuss here, but it's a concept. It's something that most people who are in the business can wrap their heads around. So with that tool, I think we are able to convey to anybody with capital of who we are and what we can provide to them. And if there is a need for our services from their side, then the chances that they invest is relatively high. Now we fail also, and let me now use this as a transition to failure. So failure is different from rejection, at least in the sort of narrow sense that you're already in the game now. To use the athlete analogy again, now you're in the team, you got accepted by this higher level team, but you didn't have a good game, or you made a mistake, or you made several mistakes. In the hedge fund business, it's, well, you didn't deliver on your promise to generate returns. For example, we at Orange Capital Partners, I just told you in the prelude, our annual performance is, of course, dismal, to say the least. And that's not what we promise our customers. That is not what we are supposed to do as hedge funds. Because as hedge funds, as opposed to long-only funds, we're supposed to react to extreme situations, avoid them, or make money with them. And we weren't able to do this in this cycle. I've spoken about this before. I think the reason we weren't able to do this is not because we didn't see it. We actually saw some of the signs very early on when we, if you want to go back to our sort of New Year's footage, when we did the road trip to Salt Lake City, we spoke about the looming signs of recession, and we explained back then why we didn't act in terms of, let's say, selling all our assets or maybe even shorting stocks. It's because we're invested in positive assets, and we saw the positivity and the demand surge for electric cars. And since Tesla was our biggest position, still is, we just thought, well, because of all the positivity, our mental set was not ready for negativity. And it's almost the inverse of when people say you're always negative, bad things will happen. When you're always positive, when you manifest positivity, and being invested in Tesla is almost, there's a necessity to be manifesting positivity because A, it's very risky, but B, it's also very controversial. So you need to have that positive energy that emanates from people like Elon Musk to even survive an investment like that. And we have that. I mean, I'm not complaining about that. I'm just saying that that's why we weren't able to catch this negative cycle now. Now you might ask, well, why don't you short now? It's still time. And that's certainly true. The way we see that is that we think that inflation is peaking, that we will have a reversal of the Fed decisions within the next 6 months, which will be anticipated by the market pretty soon. The risk, the only reason we would still want to be out of the market or short is just if a big shoe drops. Let's say the U.S. housing market collapses and we have a banking crisis in the U.S. So those kinds of things are the big risks. We actually believe that the inflation risk as a risk is not worth acting upon on the short side anymore. So let's get back to failure. How do you deal with failure? How do we at Orange Capital Partners deal with the failure right now? Well, we assess what we did wrong, like I just did. I said we had too much positivity in our portfolio. We couldn't see the negative stuff. And we then, of course, assess where we stand and should we error correct. And the cost of error correction right now, we believe, is that if we now error correct in a sense that we do what we should have done 6 months ago, we believe that the cost of that could be much, much higher than doing nothing. So we stay put. This is in a nutshell how we see this situation. So let's get back to rejection. I think that is the harder thing, because failure is, sorry, just to finish failure. In the end, failure requires you to really understand why you're in this. So the hedge fund, why are you in this business? The athlete, why are you in this sport? And then once you understand that, calibrate that against the reality. So if you're in this business like we are, to invest capital for future projects that we believe will be enormously profitable and good for the world, if that's what you're in for, if you're excited about new innovations like the electric intelligent car, like Web3, like CRISPR-based digital life sciences, if that excites you, if you learn, if you read by being motivated about these things, we're doing classes on computer architecture, on quantum algorithms, quantum machine learning. If those things excite you and you see a relationship between your portfolio and what you're learning, if all these things go natural, if your curiosity is there, then your body, your neurosystem, your whatever sensor system you have is telling you you're on the right path. And this is where we feel right now. So, but on the rejection side, how do you deal with rejections? I think the fundamental problem with rejection, again, is you're not able to calibrate yourself all the time. So you will have rejection. In fact, somebody who's never had rejections is making a mistake, because that means they're not reaching. You got to be a little bit uncomfortable sometimes. And you got to have that no. Sometimes the no has to come. You can't always be right. This is almost the analogy of having a portfolio that's never down. There's something wrong if you never get a no. There's also something wrong if you always get no's. But of course, you got to optimize that. I would say a good optimal yes to no ratio would be, I would say 3-2. So 3 steps forward, 2 steps back. Try to, because obviously you want to grow. You want to grow as a human being. You want to grow as an athlete. You want to grow as a hedge fund, whatever field you're in. So let's get back to the athlete. If you do 3 things and you get 2 rejections, but one of them, if your ratio of success to failure is 3-2, that's what I mean, which means obviously out of 5 things you get 3 positives and 2 negatives. So let's say you're playing a tough game, you do well. You ask to play higher up, you play higher up. Then you ask to play higher up again, they say no. Then you go and you try out with a very, very good team and you do extremely well and they're all happy with you. That's a positive. So you have this this positive experiences, and then sometimes it's a negative. And again, the negatives in the rejection case are often, and I'm happy to maybe look into more details. If anybody has statistics on this, please send it to me on the comments. Send me the link. If there's stats on sort of what is the amount of rejections that people get, let's say in sports, is related to simply the question of capacity. Do we need a player right now? Or is it based on the quality of the player? There's the 4 reasons you are able to join a team. And I'm paraphrasing Matt Sheldon here. A shout out to Matt Sheldon's podcast, Being Elite. The 4 things are: number 1, are you at the level? Number 2, do you fit the philosophy and culture of the team? Number 3, is there a spot for you? And number 4, do you want to join? So those are the 4. If they're all 4 yeses, you want to join, you're going to join. If one of them is a no, you're not going to join most of the time. There's some caveats here. Maybe the capacity thing could be, well, we're going to put you on a waiting list and all that stuff. But generally what I'm trying to say here is that it's very often the level side is the one where you actually as a player have a good sense for where you stand. It's all the other stuff, the culture, philosophy side, where you often don't understand. So you need to iterate more to understand which culture you fit in and which you don't. Then the capacity side, there's not much you can do about that, of course. And you can do some research in terms of, okay, how do I even know who has capacity? And I think the best way to know is always to ask. do you guys need a player? And you often get a very honest answer. This is another very big takeaway, excuse me, and allow me to go on a tangent here, but I think asking very bluntly, do you need a player? Do you like the way I play? Do you like my personality? Ask. You will get honest answers if you ask honestly. If you ask convolutedly, I don't know if that's a word, but in a convoluted way, you will get a convoluted answer. Often, the way you ask is going to be also the manner at which you get the answer. So if you're into transparency, which I think is the best way to iterate, the best way to lower the cost of error correction is to be transparent, because then you quickly learn what's wrong. So ask, be blunt, be crisp, and you will get blunt answers with crisp answers, and they will be yes or no's. And if there are no, then try to understand which one of the four is it: level, philosophy, personality, capacity, and do I want. Again, the last one, do I want, obviously is up to you, and we can have a whole episode about how you should decide between several offers. Again, there's a general way to talk about this, which applies to athletes as much as hedge fund managers. That's why I'm using these both analogies. So to summarize, rejections and failures, in the extreme, the same thing. But of course, in the narrow sense of the world, it's not exactly the same thing. And I think rejections, importantly, are based on the four factors, again, level, philosophy, capacity, and do you want to do it? And very often, it's not the level, because the level is the one thing you're able to assess the best. It is the other things. And then ask, be very blunt. Ask the people that you're dealing with, what is it you want? What is the personality you're looking for? Even if it's a yes, ask them, why did you make a yes? Is it my personality? Because learn for the next time, so you know. This is very important. Okay, iteration is all about learning from mistakes. And you can also learn from successes. So either way, be very crisp, be very clear, and ask for what was it you were looking for? Why did you say yes to me? Why did you say no to me? Learn from every experience, every iteration, every tryout you do as an athlete, every time you play with a new team is an opportunity for you to learn what was good, what was bad, what did I learn, what could I do better. So all of these things are part of the game. And I think the more you ask, the more you iterate, the lower you're going to be able to put the cost of error and of error correction. And don't forget, compound interest is a function of iteration. The more you iterate, the more you compound, the better you get. And 5 years from now, you will be at a much, much higher level. And this is what matters both for athletes as much as for hedge fund managers. Thank you.